You're listening to Real Investor Radio with Fuhr and Jack BeVier, where we cover advanced real estate investing topics to help you stay ahead of the curve in your real estate investing business. Hey, welcome back to Real Investor Radio. I'm Fuhr, joined again by Jack BeVier. Jack, good to see you.
Good morning, sir. Great to see you.
We have much to talk about today. We have an awesome guest to introduce. Can't wait to introduce Sean to everyone. But Jack, I did a little bit of a dive on the 5-year bond. Getting a lot of calls from customers wondering about the timing. Is now the time to refi? Should I wait? What am I doing? So I went out and I checked sort of like 5 of the top, I don't even know if they're bond buyers as much as they are forecasters. So Financial Forecast Center, World Government Bonds, Trading Economics, Econ Forecasting, Oxford Economics. And I took a look at what they're talking about and what their projections are over the next 12 months for what we might see in the 5-year bond market, since we could look at the 10, from a consumer standpoint, but from an investor standpoint, I think it's always important to look at the 5-year, as all DSCR loans are sort of indexed off the 5. And what I'm seeing here, Jack, is these 5 companies are basically saying, hey, it's going to be a little bit of a sideways slog over the next 12 months. Financial Forecast Center is probably the most bullish. They're saying that we could see 2.66% yields by the end of the year. Yeah, and most of them are coming in like between 3.9 and 4.2. So weighted average of all of them is like 3.69%, which is actually great for investors.
We're right at 4 this morning.
Yeah, we're
4
like
on the dot.
Yeah.
So 30 basis points down from DSCR rates, that would be great. I mean, if DSCR rates come with it, which they should, but we didn't see them come with it when we had the volatility like 3 weeks ago because the market was freaked out. So like they didn't, just because the index went down, they took all that room as extra spread. So they actually didn't get any pass through on a DSCR rate point of view. But if we got to like a stabilized 3.7, that would be cool.
Break that down a little bit. So traditionally, if we see the 5-year treasury yields go down, DSCR rates go down almost always with that downward new 5-year. And so in this case, in the last several weeks, we saw the 5-year go down to like 3.6 and everybody's excited, phones ringing off the hook. But what we saw was our biggest note buyers were like, you know what, we're just going to increase our index, a little bit more revenue, increase the spread, catch a little more revenue. We don't really know where it's heading over the next couple of days, weeks. And so that's what we saw this time. You've been doing this a long time. Have you ever seen them do that before?
Yeah, and it happens. So when they're not being greedy as much as they are being defensive, because if bond spreads, like if the credit spread of the non-QM securitizations that they go do, right? Because they're going to buy these DSCR loans, go do a securitization, put those loans generally into a non-QM, non-qualified mortgage. This is basically anything other than Freddie and Fannie gets called non-QM. And so they're going to go do a non-QM securitization of a whole bunch of mortgages. They're going to put DSCR loans in there. They're going to also put bank statement loans in there. All the other non-QM products are going to go into this big securitization, and then they're going to go issue bonds themselves. And so the insurance companies and pension funds that are buying those bonds, if they are requiring a higher spread, a higher yield on the paper that they're buying, then it means that the cost of capital for these loan buyers has gone up also. So in times of volatility, no one knows where like spreads are going to land, right? Like, is the world permanently riskier or not is an unknown question at those moments. Like we had 2 weeks ago, that was one of those points in time where like no one knew what was going to happen next week. And at those points in time, you don't see people following the base index in terms of pricing. You see them kind of being defensive and waiting to see where everything falls out. Now, when everything calms down and securitizations are being issued and sold, and there are market reference points because deals are happening, and so we can use those last deals as a comp, then you see those credit spreads stabilize. And as a result, you see loan buyers move their pricing with the underlying index. But those periods of volatility, kind of all bets are off until things stabilize. And so anyway, yeah, that's what we saw. Like, since it was just a boop, boop, like, big drop, big back increase. Well, they were correct, right? Big drop. And then a week later, it was back above where it was before, right? So if they had followed, right, if they had paid more for those loans in that week, during that week, they'd have gotten themselves screwed. So it was intelligent, right? It was the right move, Monday morning quarterbacking this thing. But that's what they were worried about. And then that's exactly what happened. So, things are starting to stabilize a little bit more. Some deals are getting priced again. And so I think if we saw, like you were, if these projections are correct, that like we get another 30 basis points on DSCR rates before the end of the year as 130 basis points, that would be pretty great.
That'd be tight. Well, we've got an awesome guest today. I'd like to introduce Sean Tierney. Sean is the vice president of Intera. Intera is the first full-service AI-powered platform built specifically for real estate investors buying and operating single-family homes. Before Intera, Sean started out at Morgan Stanley, working his way up through institutional sales and later into securitization products. So I'm sure he has a lot to talk about on our last topic. He built relationships with hedge funds and pension funds. He then worked to build Sylvan Road Capital and Havenbrook Homes, which is where I think you met him, Jack. And he raised over $450 million single-handedly, Jack, just out there dog and ponying, doing, raising $450 million for the single-family rental strategy. And most recently, he helped launch Freddie Mac's pilot program for SFR portfolios, and he also worked with CoreVest. He is now the vice president of Intera, which I assume we'll be talking a lot about today. Sean, honestly, man, we get some amazing guests on this show, and I'm just always so fascinated that they would take the time with us, and I'm sure that speaks to how much you respect Jack. Hopefully by the end of the show, you'll say the same about me, but, the jury's still out. I don't sail for a living, so I got no stories there. But anyway, welcome to the show, and thank you so much for taking the time out of your busy day.
No, I appreciate it. It's an honor to be here with you guys. You guys have built quite a following. Your list goes to show the presence that you guys have in this space, from economists to operators to all sorts of folks, that I know and respect in this industry and other industries. So congrats to you guys.
We're just the little engine that could on the internet, man. Just keep plugging away at it and building a following. And it's great. I mean, honestly, it's been a joy indeed. So Jack, before the show, you were mentioning that you met Sean in Atlanta when you and Fred were buying a whole bunch of houses there. And so why don't you start us off with a story and then we'll jump in.
Hey, yeah. So that's how Sean and I met. We were the guy down at the courthouse steps, buying houses, getting them fixed up. We went down to Atlanta back in 2011 and started buying houses, which was just like great timing just before the institutions got there and the cat, got out of the bag. And then Wall Street showed up. But by 2012, Wall Street showed up. And so we were buying houses, fixing them up, and we were just running out of cash. So we had to sell houses to recycle it. So we were selling turnkey rentals. So we would buy like 30 houses a month, fix them up, get them rented, and then start selling them to hedge funds and insurance companies and private equity groups. And Sylvan Road, which later became Havenbrook, right, Sean?
That became our operating company. And then we sold off Havenbrook to, long story short, but now it's part of Freddie, actually, at the end of the day.
Yeah, part of the big roll up along the way. So the big fish, small fish gets eaten by a bigger fish, gets eaten by a bigger fish,
And Sylvan Road is still actively out there.
So yeah, that's where we met. I had houses to sell, and Sean was there. He had money to buy houses, and so we'd sold a bunch of houses. Or we did a bunch of business together, had a good time, and just always kept in touch since then. And then you were at CoreVest. Can we talk about that pilot? Because that was really cool, and it kind of lost steam. But at the time, no one was really like, there was no podcast format to talk about it. But that was like a really cool moment. Can you talk to us about that?
Yeah. So I was actually with another company at the time when I was doing that called A10 Capital, which was here locally.
That's right. Yes.
But that pilot program was based off of the kind of the tail end of Fannie Mae trying to do some interesting things but they ended up getting their hands slapped by when they started doing some public financing for Invitation Homes, using kind of that public money to go finance a large institution, which was fine. But the pilot program itself was really geared towards owner operators that had about $5 million in value of properties. And they were trying to build a national program that was going to help, build out where the private credit groups couldn't do, or the private lenders couldn't do, right? Freddie Mac doesn't really have the same kind of constraints as far as geography. If you have 150 homes in rural Alabama, great. They can absorb that as a portfolio. There was a lot of interesting characteristics where they wanted to go put out to it, and they got a few loans done. I think we ended up doing about 100 loans, fulfilling the $5 billion that they wanted to go deploy. There was just some issues at the end, some politics, and that went way above my head and pay grade, but it was still a really phenomenal program at its heart.
Because at the time, what year is this?
This was like 2016 to 17. I believe.
Right, so this is like B2. This is like B2R finance, first key and CoreVest, slugging it out on the rental, on the long-term rental side, but
you
only
got it.
yield maintenance.
New entrants like Lima and Lending One were kind of just getting into that longer-term financing, right? These were. And the loans themselves were very simplistic when it came to it, right? It was 5, 7, 10-year type debt. IO was almost like a new kind of crazy feature that they were offering to certain groups. Alan True, I believe, with True Homes, was the first one to get the loan done across the board. It was, and there was about 4 of us that had licenses for this program, going out there and, because you need a license to operate for Freddie Mac, and, it was a great program that got cut too short, and I think it would have provided a lot of growth. And still to this day, I think that there could be phenomenal benefit from a agency like, you see it in the multifamily space all the time, right? And the securitization, as you were talking about earlier, becomes so much easier too. You put things into K deals or Fannie K deals or into DUS deals and CMBS type structures, and it just starts building that wheel, and with it you can start financing better and more efficient.
Yeah, so just to contextualize why I'm such a nerd about this and like I'm dwelling on it is like, so at the time, like there was a very burgeoning kind of like SFR long-term financing market, but rates weren't very good. Like they were
Correct.
still like above bank rates by like 150 basis points. So like there were, and so the funds, like the small private equity groups, not even small private equity, like all the private equity money that wanted to be in single family real estate would go to the local banks, and the local banks would be like, who's going to sign personally? And the fund GP's like, dude, I'm like 2% of the fund. Like I'm not signing personally I own 2% of this thing. And so like, they'd be like, guys, I got $100 million of capital to deploy into single family real estate. We need to we need affordable housing and to stabilize this real estate market, and no one will freaking lend to me. And so Freddie Mac, so everyone was banging on the door like, hey, Freddie Mac, you got this multifamily program that like is the market for financing multifamily properties. This is the same thing, just take one address and put in, 37 addresses, and it's the same damn product. Like, you can't get your heads around this one, guys. Like, this is like so freaking mission, it was very mission driven. So frustrated. So they finally were like, all right, let's try it out, and used that like Freddie Mac path of like giving licenses to certain originators who were trained on the guidelines, and basically it was going to be like the single family version of Freddie Mac multifamily, and everyone was jacked. Everyone was really
excited about it. I think some of the private lenders were some of our competitors, it was because it was going to almost take, all of a sudden, as you were indicating, right, those rates were 75 basis points cheaper when they are trying to do it. And they were a little bit concerned on how it was going to eat up their own book, because they weren't going to get some of the servicing aspects of it, and they may have lost out on some of the origination fees. But overall, they were very supportive of the deal, because at the end of the day, it was going to be flow for some of their other products, right? Some of the bridge into a Freddie deal, or something along those lines.
Yeah. And then so they start to put this paper on the street. And was it at the beginning or at the end that they did the Invitation Homes deal?
Well, so Fannie Mae did Invitation Homes, and that's where they got their hand slapped. But then Freddie Mac ended up doing they ended up financing part of the The name escapes me too, but it was another large institution that's now, it was like an Altisource group. It was actually part of the Havenbrook name that got rolled up, and they ended up doing some public financing with it that probably shouldn't have gotten done at the time. That was kind of the end of that program. I don't think that.
No, good.
I was going to say, I don't think that was kind of the nail in the coffin, but I do think that was one of the things that was frowned upon. There was also some, some pushback from the NAR, the National Association of Realtors. They were against, agency funding, because the theory was, or the working theory was that, because these private equity groups didn't need licensed agents to buy real estate, they were going to be taking out some of their commission, which, if you actually looked at the data and looked at how these groups were actually purchasing, they were always using some sort of an agent at the time.
Yeah, but the fear of Wall Street coming in and buying up Main Street is not a new thing. It's pervades, but it's not a new thing. Yeah.
No, it is not. It is not. And so it got, unfortunately it was taken out. I think it was First Key.
So yeah,
not First Key, Front Yard Homes.
Gotcha.
That was the transaction.
So the institutions try to dip their toe into the water on getting, getting into this space.
Getting into that agency financing as well, because, the securitization market really hadn't formed for them either. And so, there had been a few securitizations back then, but, it really that wheel had not started yet for them either. And so this was sort of their ability to use some good financing for them to grow their engine.
Yeah, so their involvement, or that the institutions, that the private equity groups ended up getting that financing, ended up kind of like killing it politically.
Correct.
And then, so then we went back to zero, and then ironically, at the same time, the non-QM market, the DSCR market, that kind of left a vacuum, right?
It did. Yes.
That Verus, I think, was one of the early entrants. Maybe there were some others too, but Verus is the one that at least was on my radar at the time. Put together the DSCR loan and started to tried to make that a securitized product. And that ended up being that, that's what came out of it, right? We don't have today, we don't have a Freddie Mac single family option.
There's no agency. There is no agency like deals, right? I mean, even you've started to see you see the non-QM deals, but like the CoreVest of the world, their securitizations have slowed down, and now you do have
Encore. Doing a similar kind of product, some direct to insurance company stuff for the bigger private equity groups. But but over the course of the past 4 years, since the institutional aggregation pace has slowed down, there hasn't been that push for that side of the market like there was before. Now it's kind of gone back to the mom and pop, people 100%. Buying a couple houses at a time. And so the DSCR product has ended up being kind of the overwhelming volume on the single family origination side at the moment, right? At the moment. But that's kind of the point. The reason I wanted to dig in here is that this has been an evolution over time, and depending on the market conditions at the time, the financing markets have tried to adapt and fill the need of what the predominant equity was being deployed at the time. At the moment, it's kind of back to mom and pop acquisitions, but that could and probably will at some point shift at some point in the future, and the debt markets will adapt again, and we could see a reemergence of CoreVest and Encore and the insurance
I think you
product.
have, though, right? I mean, I think that, to your point, it is 100% driven by the mom and pop retail investors right now. You're seeing some really interesting things coming from, the Dominions of the world, the Kiavis of the world, all of these guys. I always kind of, in the back of my mind, I always think all these lenders should be slowing down with where rates are, but you continuously see headlines of, such and such lender, $5 billion in origination, or this the lender doing $1 billion in origination last year, right? And they are becoming, whether it's through bridge financing or, term structures. I think most of that, if you were to look at the data, would actually push towards the bridge, the short-term financing. But the ability for them to still continue and push out new product really goes to show that fortitude that they have, and to be creative. And coming from my prior, a life way time ago, they're not pushing credit risk, right, to make deals get done, right? I think we saw, in 2006, 7, and 8, didn't matter how that loan got done. it got done, right? Now, on these bulk portfolio loans or even on the one-off, their credit underwriting is still pretty sufficient to cover these, and defaults are low. We talked to, the lenders quite a bit. They're seeing delinquencies start to tick up, but nothing concerning in that, 2 to 3%. Maybe it's a little higher off books.
Yeah, that's what I'm really interested in the next phase here. Like because the DSCR loans specifically, just picking that product, have become part of rated securitizations. The rating agencies now have a lot to say. Like they're a big driver of what ends up on the street. Because if the rating agency frowns upon that feature, no one wants it. No one wants it in there, right? And so, as we see delinquencies, I think continue to increase. They've started to increase. I think they're going to continue to increase.
Yeah.
We have the real estate side of things in Baltimore, and so I look at the courthouse foreclosure auctions every week, and I've got VA who puts together this spreadsheet, and one of the fields is who the defendant is. So it's so and so trustee versus Joan Smith deceased, right? Is like your typical. For the past 5 years, it's been a lot of cleanup of post-COVID foreclosures that just didn't happen. A lot of folks who just who just passed away, or just kind of normal foreclosure activity. But then over the course of the past 4 months, I've seen a noticeable increase in LLC defendants, and then I go on land records and see who the plaintiff was, and it's one of the 10 usual suspects of private lending. Those foreclosures have started to come through, and those folks are about to figure out what severity given default is, right? We had a whole bunch of assumptions in an Excel spreadsheet as to what was going to happen if this thing went sideways, and now we're about to find out how much you lose on a foreclosure in the west side of Baltimore. So and then that feedback loop is then going to go back up to the rating agents, the remittance reports on the securitizations that are being read by the rating agencies, and then that's going to flow back down into guidelines. So I think we're at the beginning, we're in inning 2 of that feedback loop right now. So it'll be an interesting.
And you brought it up earlier too, right? The investors also demand different, whether it's higher or lower LTVs, or they require some of those credit features into those bond structures as well, right? Where to absorb the credit risk that they're going to have, not just a premium, right? And saying, oh, I'm not going to pay this for the bonds, I need to pay a lower price or whatever to make sure that credit risk. But there better be some structures in those DSCR loans that protect me, whether it's a first loss prevention piece, or how does a waterfall structure look like. So I think that those two, and then the rating agency steps in and puts a check to it as well to make sure that those sorts of features will play out the way they're anticipated. But those are all theoretical, it's all great. As you said, it's all great on a spreadsheet that says, oh, I'm only going to have 2% loss, and it's only going to my unpaid balance of, whatever it is. And it could be more.
We're about to find out. It's gonna be fun.
So getting back to the whole Fannie, getting into that, was strictly the product that you were talking about with CoreVest would be I've got an investor, he's got 100 houses, we want to roll that up into a Fannie agency.
Freddie, yeah, it was a Freddie. Yep.
So let's just play it out. If they were to get back in the space, because I feel like DSCR pricing is pretty competitive, these days for a 30-year fixed over walking into your local bank.
Portfolio is hard though. Sorry to interrupt. Portfolio is hard right now. Can't really.
The question is though, how much better would the pricing be over what we're offering now?
Sure. So I think it's two components, right? It's not only is its pricing, but it's efficiency in what they can underwrite. There is no, again, right? So let's say pricing is 50 bips tighter. Let's just make it up as the number, right? But it's also what the type of product that they can underwrite, i.e., they don't care if it's 100 homes in Baltimore that are all worth $25,000, right? Whereas some of the private credit, the CoreVests or the lending ones of the world may have some regulation around how much they can absorb. Also, the population, right? If you were into smaller population places, Freddie can say, look, we don't care if that population is below 100,000 people. We'll go finance it. So I think it's twofold, not just pricing, but it's the type of product that you can get into the portfolio loan that
Interesting.
makes it so valuable. And eventually it becomes part of the efficiency of getting that loan, which is where I think Freddie struggled at first. They took all of their multifamily underwriting and just sort of plopped it over into the single family rental space, which is, we all know, is not the way that things work. And right now, right, if you look at your average owner operator of a mom, I'm sure Jack's seen this 100,000 times, right? And ask them, hey, let me see your 3-year P&L statement.
Yeah.
That just doesn't exist, right? Or, let me see your receipts for all your CapEx expenses for the last, 18 months. If you do get something, it's going to be a shoebox and it's going to be disorganized. That methodology did not fit into the Freddie Mac kind of way of thinking of how to do a loan. There needed to just be some operational changes. And I'm not saying either group was right. It just needed to meet in the middle a little bit more. And it would need to meet in the middle a little bit more.
Craig, to put some numbers to what you're asking, so like Freddie Mac fixed rate 1.25 or 1.35 DSCR, 70% loan to value, 10 years with 9.5 years of yield maintenance. So like very restrictive yield maintenance. So let's, to be fair, very restrictive prepayment penalties was mid or high fives. So like it's now that's got yield maintenance there is a portion of that, like, versus the 5-4-3-2-1 prepay, which is like what we write the most of. There's a difference there. There is a little bit of a pricing bump because of that feature, but 100 basis points of rate, basically a delta between the multifamily financing market and the single family financing market. And that is, that delta existed 10 years ago, but it was the banks who were 100 basis points higher than the Freddie Mac multifamily rates, right? But they were doing single family. The banks have kind of been supplanted, right? The rates are on par now with bank. The DSCR rates are on par now with bank, but there's still a delta. What the point is between multifamily and single family on the same, on the same equivalent assets. And so, which ironically, that should on an investment basis lead to like a difference in pricing between single family and multifamily. We haven't seen a whole lot of great multifamily deals, or, there's not a whole lot of multifamily deals happening right now. So no one has been paying attention that much to the multifamily rates recently. But by the by, you can still get high fives financing right now on multifamily projects. It's just super hard to find a deal that actually has 1.35, x debt service coverage ratio because Freddie Mac actually underwrites debt service coverage too. They don't do PI. That's not a PITI. That's like a real 1.35x. So it's just really hard to find a 7.25 cap right now on the multifamily side.
Isn't there a loan limit with them though? Like if you're like a mom and pop going out and trying to get a Fannie or Freddie loan for an investment, isn't there like
nine? Wasn't it?
It was like 9 or 10, and
it was 9 or 10 on each. So it was on the Social Security number, from my recollection. I haven't looked in a bunch of years, Craig, but it used to be it was limited to a Social Security number, and you could get maybe 9, and each one became progressively harder to get because you had cash reserves and net income requirements that each loan you had would deteriorate that all of a sudden because you weren't allowed to use your net worth requirement, or you weren't allowed to use a house that you already had invested with Fannie or Freddie as a net worth requirement unless you were worth $10 million, right? It would start to decrease every single time.
Not to mention, it also counted against your credit. And so you could be this guy like with 10 highly performing houses, making all your payments on time, and you're rocking a 680 credit score because all of these things go against your credit. And so I always thought that was like the limiting factor where, whereas like the private lender distribution network for DSCR, there's no limit, and it doesn't report to the credit agencies either. So it just felt like DSCR just feels like a better mousetrap for me right now than going out to the agencies for investor products.
Portfolio is still a whole though. And I think like the market's not like DSCR portfolios are kind of tough to get done. You have to break up the 80 unit portfolio into a bunch of 10 property portfolios and sell it to like 6 different guys in order to get those deals done, which we can do and are doing, but it's a hassle, right? Or like the alternative is that you go to CoreVest, you go to Encore, you go to, direct to an insurance agent, insurance company. If you have like several hundred houses, you probably get a direct deal done through like a Berkadia or somebody. But that portfolio refi is a missing middle right now. But there's not enough. I don't think there's enough of those deals happening that aren't already in CoreVest, and CoreVest is just like extending you for like the market to like really solve that problem, for there to be enough demand for that product that the debt market like gives a shit, frankly. So that's just kind of like, that's the missing middle right now is those it's the 10 to 50 unit or 10 to 30 unit multifamily and the 20 to 200 portfolio single family is kind of the hard part right now to get done.
Yeah. And it is, right? I mean, we see, we actively trade portfolios for our clients, out there, and it's quiet, right, on the portfolio trading side. And it's because the rates are so preventative, and that, where buyers and sellers are looking to exit, and there's obviously a pricing component to it where, execution, if you're looking at a portfolio of 40 homes to say, all right, I want to get rid of these, what's my best execution? Well, it's more than likely it's just selling it to retail, right? And versus trying to go ahead and sell that 40 homes to another investor, because it won't work from a lending standpoint, and it may not even work from a cap rate standpoint. So it becomes very
I was going
challenging.
to ask you, like, the sort of the low velocity. What's the defining factor there? I would just thought it was just rates at this point. That just can't make the
I think that highest invest. In 2021, when demand was so strong from everybody, I think that everybody was willing to pay a premium, or you would be able to take out, a 100 home portfolio very efficiently. Now it's just investors are willing to get creative on their finance. Let's say if they had a term loan coming up in 2025, right? They would just get a bridge loan to pay that off, and then say, all right, I'll use over the next 18 months, I'm going to go sell my 40 home portfolio, versus trying to pay off in one fell swoop. Right. And so I think that we've seen a few of those transactions going down. We have seen the investor loans extend, right? And they want to keep it on their books, and say, all right. And we're also seeing, in the limited inventory that we do see trade, investors are willing to pay in that 6.5% to 7% for term financing, in a long-term portfolio loan. And so they're able to make it work, which is always
on the spreadsheet. It works great.
On the spreadsheet, it works great until 2 vacancies come up. You then get, cash lockboxed, and you're, or cash trapped, and, all of a sudden, you're selling your portfolio for a deep discount.
I'm 100% going to take cash lockboxed and start using that. So thank you. Never heard anybody say the cash lockbox before.
I believe it's in some loan. If you read loan docs occasionally, it used to be a term in there.
Really?
Yeah. And I think the fun part is, Craig, so when you have to go set up that lockbox, let's say if you're an owner operator and they say, oh, you need to go in original loans, right? Like this was back in the day. They would go, to go get Wells Fargo to set that up for you. It was like $20,000. So it was not for them to operate that cash lockbox for you. It was expensive. So not only are you now paying for that lockbox to operate facility, you're now not getting your cash, and it's going, and the bank the lender gets to distribute everything. So that's a bad place to be.
So man, let's step back, and you've obviously had an amazing career. Love to know like how you started out, and you can go quickly through, ending with CoreVest, and then the idea for Entera and joining up with them. So yeah, I would, give us the story, man. Like, tell the listener.
Well, amazing is probably
not every guy that comes on the show is born with a silver spoon in their mouth. Most of the guys work their way up from the bottom, and are where they are after a lot of hard work. So yeah.
I fall into that category, right? So I was very lucky and fortunate to go into Morgan Stanley on a January day, and I didn't happen to trip when they were looking for somebody on their short and medium term financing desk. And I had a Series 7, and they said, "Great, can you start next week?" And this was in San Francisco in about 2003.
What did you study in college?
I had a double major only because I went to school for so long. It just seemed to make sense. You hang around the hoop enough, and they keep giving you credits.
Right.
And so it was a major in business economics and business. And so I graduated from a small program in Moraga, California, called St. Mary's, that actually makes it to the sweet. Or no, they make it into the NCAA basketball tournament. That's kind of their claim to fame.
Right. So you walk into Morgan Stanley with your 7-year bachelor's degree.
Yep.
And
It was 6,
somehow,
but that's okay.
close enough. Somehow they're like, this is our guy. Like, you're not exactly like, walking out of Stanford, like.
Correct.
Yeah.
And so that was it. And I was placed on a desk, and it was awesome. I really have to say I was with great mentors. The culture there was phenomenal at the time. But I was doing a lot of what was called, it was money market funds, and I was covering these large, household names: Dreyfus, Fidelity, PIMCO, WAMCO, all these, because I was on the West Coast, and you're covering these names. And I was a 21, 22-year-old analyst doing, billion-dollar trades every day. And you're like, oh, I must be really cool. But then I saw these guys next to me having a really big time. And they were jumping on planes and, having big parties and, doing all this stuff. And I wanted to figure out what was going on that desk. And that was the securitized product group, which was responsible for everything that had an acronym. And so in 2006, I switched over to the desk. Unfortunately, I was there covering all the large institutions, both on buying the loans and securitizing them and then selling the loans on the West Coast. So we covered all the large mortgage institutions that are no longer with us, and a lot of the large funds that ended up blowing up, and pretty much we're at the epicenter for a lot of what happened in, the great financial crisis. Which,
were you still working at Morgan Stanley during that time?
Yeah, because I was young and cheap. Right, I didn't really, I kept my head down every time HR would call, and so they would look around the room, and they'd see an older guy and somebody who cost them a little bit, and that's who would usually get, unfortunately, who was laid off. And it was hard, man, for being a 27-year-old thing. You're not really mentally equipped to handle that stress of the stories you're hearing of what's going on financially. People coming to you and blaming you, and you're just like, I don't know, man. Like, and you had Dr. Burry calling you and being like, why are my bonds marked at par, but you won't buy them at par? He was famous for the great story.
Yeah. So are you the guy? Are you the guy he's calling on that desk?
May or may not, but
that's wild.
He would call because he was buying a lot of the corporate credit bonds that was traded next to me, and then I was covering, once I moved over to the securitized product group, we would he wasn't my coverage, but he was covered by another guy out of our desk, but I would have to help him get his trades and his short trades on, and it was fun, right? And then in 2007 and 8, things started to change. Nothing but positive things to say about Morgan Stanley. I left in 2012 because there was a gentleman who sat next to me who was the U.S. housing, and I'll go quickly here, but he was the U.S. housing economist, and he was a guy by the name of Oliver Chang. And he started writing some really interesting papers that are still out there on the institutionalization of single-family rentals. And
he was like the first Wall Street guy who and everyone was like, looked at him like he was crazy.
And so we would go and, because I was a sales guy, and we would do these like dog and pony shows and bring out, you're an analyst, and he would bring this up in these meetings and, with large institutions. I'd be like, no, we'll never put money into this. We don't believe it. It's too, the risk is not there. It's never been done before. But then you'd get the guy who, as you're walking out of the meeting, would go, hey, if you do this, I'll give you $1 million out of my PA. And so, Oliver and I started doing this enough times, and we're like, I think we just raised 20 million bucks, as a shadow book. And so in 2012, I actually left to go to another institution that went bankrupt, unfortunately, called MF Global. It was a longer story there, but they went bankrupt. I saw Oliver Chang on CNBC one day and said, hey, we should, connect again. And he said, yeah, let's go do this. And him and 4 other people started a group called Sullivan Road Capital. We went and raised, using kind of the relationships that I had built over the years, raised that 453 million. I always bring up the 3 million because that was the friends and family. And I have to say, raising 450 million was easy compared to trying and hitting up my friends and family for $3 million. So anybody who goes out there and says raising money is easy is from friends and family.
You're hitting the guy up for 50 grand. That's like a friend. And he's like, that's the last 50 grand I have, Sean.
Totally.
Don't mess it up, right?
Don't mess it up. And you would get those calls.
Dude, I'm so intrigued by this because here you are fresh out of college, probably weren't dreaming that you were going to walk into, an investment banking job. I don't know if was that the plan, or is it
No,
just
I wanted
happened
to live
that
in
way?
Australia and hang out.
There you go. So you were going to go wrestle kangaroos, but instead you walk into Morgan Stanley and you learn sort of very quickly how to talk the talk and walk the walk with very large scale numbers, which I just find I think guys like Jack, he just sees the numbers. Jack just sees it in his head. He just compute it's that. But I don't think everyone understands. You get on the phone and you're talking to guys about hundreds of millions of dollars, and you're 23 years old. It's insane to think that. And the
100%.
question is how did all of that quickly condition you for when you went out and raised the 450 million? Did that feel daunting to you, or was it nah, I got this? We know
what it actually prepared you for is that you learned that quickly that CIOs are people too, right? And I had the ability to talk to some of the top groups, Bill Gross at PIMCO, or some of these large groups that you would read about in the New York Times, the Wall Street Journal. They'd pick up the phone and yell at you on an average Tuesday and call you all sorts of names, but at the end of the day, you'd go and grab a beer with them, right? And so you learned that these were just people and not to be intimidated by them, I think, was the key thing that I learned, and that it was okay to go and ask. They may hate your trade idea, but at the end of the day, they may even yell at you, but it's okay. And so I think it was a little bit of tougher skin, just going out there and learning and then having that ability. I think, and that's where some of the challenges, I think that Invitation Homes in Dallas did a great job when they were first starting, being able to connect John Gray at the time and saying, hey, look, this is how we can speak your language, so Blackstone can go give us, $1 billion. And I think that was, and to this day, I think that's challenging to go bring the SFR industry into the, Norwegian pension fund or the Saudi, that language still is not there. And it takes, it's an interesting kind of group that can go in and talk both sides of the fence and say, oh, I understand why you shouldn't have ceiling fans in your homes because they break, but also I understand why, your convexity of your mortgage bonds is underperforming, and this may be a better delta to your, there. So it takes a little bit of that skill.
Yeah, you are definitely walking into those meetings with all the receipts. It's not fluff. Jack, you've had to do many of those sort of dog and ponies looking for capital. What's it like? How has the last 20 years of Dominion, conditioned you to walk into a meeting like that?
We had a difficult time communicating raising capital in the single family space to large scale equity, because deploying capital into houses is hard. Deploying houses $150,000, $200,000 at a time is a shit ton of work.
Yeah.
There's a lot of operations that goes into that. And I think that you have seen that idea play out in terms of which real estate institutional capital, which single family real estate institutional capital has gone into, and where it's gone in and gotten its butt kicked and then retreated and gone back out. Because we were Baltimore, because that was our backyard. The idea of deploying institutional capital in Baltimore is a really, really, really challenging idea. We've seen literally half a dozen groups come in, think that they're going to crush it because the gross yields look great, and then just get their asses handed to them and tuck tail with a loss on the way back out of the market. So, deploying that capital is easier said than done, especially at the small scale of a couple $100,000 at a time. But then the Sun Belt, where the operations are a little bit easier and the variability of the product is less, obviously institutional capital has deployed a tremendous amount of money into the class. It can be done. It has been done, right? So like that issue is settled. But anyway, we always came from a place of like talking about Baltimore. And so we just don't think it's a fit. Like we just think that, hey, like if you want to deploy 10 million bucks, yeah, we can have a conversation. If you want to deploy 100, I don't know, man, that's going to take a while. Like I don't think I can get that on the street in 24 months. Not in Baltimore anyway. So I don't know, that ends up leading to like interesting dynamics in different markets. And as a result, different opportunities for smaller investors to fill the voids like right underneath the institutional players, because we're going to have a hard time competing with their cost of capital, right? When Invitation Homes raises equity, it raises equity from retail investors with retail investor return on equity thresholds, and then it goes straight to the bond market and raises money directly from the bond market. So it's getting the cheapest equity and the cheapest debt. And I'm supposed to outbid that guy on a house? Unlikely. Like our operations can be better, right? And we talked a lot of shit for a lot of years about how these knuckleheads from Wall Street were going to screw up operations. And in Baltimore, that's true. But in Atlanta and in Florida and in Phoenix, my operations aren't better enough to make up for the difference in cost of capital. And so we just cede those markets to Wall Street because they're going to outbid us on those houses. Or maybe we can like catch some table scraps, but going heads up with them at the courthouse steps, I'm going to lose. And we have lost. We've lost for the past 10 years. We've lost in those markets. Mom and pop investors have lost in those markets.
It's interesting.
Yeah. And I think something also that's interesting too, Jack, you talked about, and I remember one time at an RIR meeting you guys were talking about, is being prepared going into the institutional investors, right? And how when you're raising that capital, have all, you guys were referencing it, Jack, at the time when you're going and getting a loan, but it was have all of your ducks in a row, be ready to answer all the questions. And I think that is a key component when you're going and trying to raise capital, is have all your ducks in a row, have everything spelt out, because you need to have, again, with the languages, not barriers, but just different languages, you need to have those kind of, things ready for them to understand and digest. And then also on the capital raising, be prepared for a long, slow haul, right? It's, you're not going to walk into a huge money market or, a large institution in day one and say, hey, I need 150 million bucks. Let's go. I mean, you better be prepared for an 18-month due diligence period and then, some contract negotiation all the way through.
Yeah, and then you hope the market opportunity is still there by the time.
Correct.
That's like one of the, everyone's like, why don't we just go direct to the insurance company? Like, if you start today, you may get done 18 months from now. And like, are you sure you'll still have deals 18 months from now? The market moves pretty quick, that opportunity door is going to be closed, good chance that opportunity door is closed by the time you get there.
Mm-hmm.
I had I've told the story on the podcast before, but I had an experience to sit through one of those type meetings with a small private equity firm that was looking to get into mobile home park space.
Mm-hmm.
These guys were literally doing high fives halfway through the meeting, saying, the mobile home park space is literally what self-storage was 20 years ago. It's just, and so the meeting went great, but what I found was, there's a lingo in those types of meetings when you're sitting with like Wall Street guys or guys that have been on Wall Street that like was completely over my head. Thankfully, not for the guy who I was there as a partner with. He had worked in investment banking and raised about $400 million for kind of a mid-tier mobile home park provider. But the most striking thing about it was probably 10 hours. We had the sharpest presentation that we could possibly put together in the time frame that we had. Like literally brought all the numbers, all the receipts, but the amount of questions and pointed questions. I mean, this wasn't like, give us your thoughts on. It was, tell us exactly what this, and, I think the deal actually wound up getting done, but you're absolutely right. So like, this guy was like, we can raise $1 billion. We'll start in April. It was December. And he was like, we'll figure it out as we go. But it was a long, tough slog for my buddy who actually wound up working with them, and not easy meetings to get through. So that's why I find it so intriguing that you've sat through so many of those, Sean. So Jack, what do you say we end this episode here? Sean, we have you for like maybe another half hour or so.
Mm-hmm.
You cool with that?
Yeah.
We'll end this meeting with Sean Tierney. This episode with Sean Tierney, and we'll come back for a second episode where we get into Intera and all the cool stuff that you're doing there, if that's cool with you.
That sounds awesome. I appreciate it, guys.
Well, thanks for listening, everyone, to this episode of Real Investor Radio. We'll stop it right here and join us for the next one with Sean Tierney and Jack BeVier.